Hello, my name is David Hillier, and I will be giving a short video on the average accounting return. The average accounting return method is covered in my textbook Corporate Finance, and the section is 6.4. And you can see the slides on the left hand side and my spreadsheet on the right hand side. In this video, it will only be about 15 minutes, and I'll be talking principally about the method, its strengths and its weaknesses, and I'll also show you how to use a method when you're applying straight line depreciation and also reducing balance depreciation. Okay, so without further ado, what is the average accounting return method? The average accounting return method is a return-based appraisal technique that asks the question, is the return earned by a potential project greater than the target return or a return that is set or a benchmark return that is set within a company? The method, as you can see by its name, uses accounting figures, and that means that we need to look at a return on investment. The return on investment, how do you calculate return? We calculate return from the net income. And how do we calculate the investment? Well, we look at the investment from the change in the book values. And we calculate the average net income over the lifetime of the project and divide that by the average investment or the average book value of the assets that you've invested in. You will accept a project if the average accounting return is greater than your benchmark, and you will reject a project when it's less than your benchmark. So let's look at this particular example. We've got a company and is thinking of buying a store in a new shopping centre, and the price is £500,000. Okay, we're saying the life of the store is 5 years, and it's going to be completely scrapped at the end of that time. So the lifetime of the project's 5 years. We're going to have to depreciate that store, the purchase price of that store, over the 5 year period. And we've got in the question, it says here, the asset will be depreciated using straight line depreciation. Okay. Now that doesn't actually happen when you've got property, plant, or equipment in the European Union. We use something called reducing balance. But I'm going to take you through just a simple straight line depreciation, and then I will show you how to do this again for the reducing balance method. Now look at just one last thing before we move on to the slide. We've got the benchmark is or the target return is 15%. So I'm just going to write these things down. Target return is 15%, and the purchase price is £500,000. Okay, so target return is 15%, purchase price £500,000. Okay, now what we do is we have to calculate the average accounting return. Now, the average accounting return calculates the average net income and divides that by the average investment. So let's set up the spreadsheet. Now you can see what we've got here, and you'll notice that there's some values that we've already given you. So we've got the revenue, which is 400. Starts off at 433,333. It goes up to 450, then goes down to 266, goes down to 200, and then goes down right in year 5 to 133. And the expenses start off high, but then it drops down to 100k over the last 3 years of the project. So the first thing we do is we calculate the gross profit. And here the gross profit is a before tax cash flow. So 433,000 minus 200,000 is 233,000. As you can see, we're just subtracting expenses from the revenue in each year. And then we have to calculate the depreciation. Now, with straight line depreciation, uh, what you do is you start off with the original price, which is 500k, and you get the final price or the residual value. And with the residual value, we're going to um, set that to zero. Why are we setting it to zero? Well, if you go to the this one, it says here it's going to be completely scrapped. We don't say there's any resale value, so we're assuming the value is just going to be zero. So the value is zero. So with that value being zero, we have this value here. It's depreciated over 5 years. So to work out the annual depreciation, we just subtract the residual value from the purchase price and divide that by the number of years in which you're depreciating the asset. So you've got the depreciation is equal to 100,000 per year, and it's the same amount every year, and that's why we call it straight line depreciation. Looking at this in a bit more detail, if we have the time here and we have the initial value in this column, we have the depreciation in this column, and then the residual value in this column. I'll just increase the size of the columns to make it look good. And if we look, okay, it's 5 years of the life. The initial value is 500,000. Depreciation is 100,000. So what's the residual value? The residual value is just 500,000 minus the 100,000. Now the residual value in year one is equal to the initial value in year two. So we have the 400,000 starts off. We know the depreciation is the same. It's 100,000. The residual value is 300,000. Again, simple process. If I copy this down, it should be the same. And going right down, we get the residual value at time 5 is 0. And so that's the depreciation schedule. And that's important when we go on to look at capital budgeting. So you get a straight line depreciation every year, and the value of the asset goes down in a straight line over time. Okay, so what we've got is that's our depreciation, and we can now calculate the profit before taxes. Profit before taxes is the gross profit minus the depreciation, which is, you can see here in the first year it's 233,333 minus 100,000. That gives us 133,333, and we do the same for the rest of the years. And we have to calculate tax, and our tax rate here is a corporate tax rate, and it's 25%. So the taxation comes on the profit before taxes, and so 25% of this amount is 33. We do that for every year, and that gives us our net income. Okay, and our net income is simply the profit before taxes minus the tax, and here is our net income. So these are important figures, and what I'll do is, well, we can keep these here for just now. Right. So we've got our net income. We've got our net income over time. You notice here that that should be a minus sign here. Now you might say, well, oh, wait a minute, what's going on here? We actually made a loss in the last year, but because we're charging tax, we're assuming that we're effectively, our tax goes down because we're making a loss, and so we're assuming that we're actually offsetting this tax gain against other profits in the company. If this was just the only project that the company was engaged in, then you wouldn't be able to offset that tax in that year. But what we're doing in this particular assumption is saying, well, okay, we made a loss, so because we made a loss, our tax bill will go down, and that reduction in tax bill will offset any taxes that you're paying elsewhere in the company. So it's minus 66,667, and we've got a minus 50,000 here. So that's the net loss really. Okay, so what we're going to do now is we're going to look at the method itself. And the method itself, there are three actual steps in the method. We calculate the average net income. We then calculate the average investment, and then we divide the average net income by the average investment. So how do we calculate the average net income? What we've got is we've got 5 years of net income, 100, 150, 50, 0 and minus 50. So to calculate the average, we just add these up and divide them by 5 because it's over 5 years. And you can see that the average there is 50,000. Now, how do we calculate the average investment? Well, the average investment is just slightly different because we start off with 500,000 and we end up with 0. So we actually have to treat 6 periods here because they were depreciating over the 5 years, and that means then that we've got a starting value of 500, it goes to 400, 300, 200, 100, 0. That has to be averaged. So to get the average of that, we can use the simple average formula, which is, so I'll do that one again, equal average. And you've got 250k, and that's what we've basically done here. As you can see, 500 plus 400 plus 300 plus 2 plus 1 plus 0 divided by 6. So we've got the average net income of 50,000. We've got the average investment of 250,000. What's the average accounting return? It's simply 50,000 divided by the 250,000. And that's equal to 20%. We compare that with the target return of 15%, and we say we accept the project. Our return on this project is 20%, the benchmark is 15%, so we accept it. So that's the average accounting return. Now what I want to do is I just want to go back and look again at this example, but this time you look at reducing balance method. Now, with the reducing balance, instead of just taking the same amount off the value every year, you take off a percentage amount of the initial value for the year. So let's just assume that reducing balance percentage is, let's just say, 20%. Now you might think, well, why 20%? Well, given that this is over 5 years, if it was straight line, then effectively 20% of 500,000 is 100,000. But we're going to do reducing balance now. So I'm going to just bring this a bit tighter in terms of smaller column. And we start off with the initial value. Our depreciation is 20% of the initial value. It's 100,000. The residual value is just the difference between the initial value and the depreciation. An initial value for year 2 is equal to the residual value for year 1. But look what I'm doing here. Now, as you can see, that we're now getting 20% of the 400,000, so the depreciation is actually less in year 2, and that leads to a higher residual value in year 2. We now need to do the same calculation for year 3. It's 64. Year 4 is 51. And year 5 is 40,000. Now, what we're going to do is we're actually going to say that the residual value, the actual resale value of this asset is 0, and that's the same as the last project. So when we do the residual value, we actually, in the last year, we set it to 0. And so the depreciation in the last year is simply the difference between the residual value that you set, that we've said is going to be 0 because there's no resale value, and the initial value for year 5. And in that case, in the last year, depreciation is 204,800. So the depreciation changes over time when you've got reducing balance, and that has an impact on your income statement. And what we're going to do now is we're going to go through, redo the income statement. I'm going to have to maybe increase the size of this somewhat. I'll try and keep this in where so that you can see. We've got year 0. Well, let's do year 1, year 2, year 3, year 4, year 5. And I'm going to make these much smaller. Okay, just, I know it creates some issues up the top, but that's all right, that's fine. I can change it again. And we start off with revenue. Now the revenue is going to be the same. So the revenue in this particular case is we've got 433,333, 450,000, 266,667, 200, and 133,333. Okay, so let's just make this a wee bit bigger. What's it going to do? Okay, so bear with me on this. It's a beautiful Scottish morning, as you can see, sun shining. So that's our revenue, and our expenses, they'll be the same. So it's 200, 150, 100, 100, 100. And so I've got I've got before tax cash flow. I'm going to just put gross profit here. Gross profit is the same because we're not changing anything. Well, what we're changing is the actual depreciation, and this is where we'll write the depreciation now. Let's call it depreciation. It's depreciation here, and now it's the annual depreciation we're going to use. And in the final year, it's pretty bad. Well, it's not pretty bad. It's just high. So the earnings before taxes. Earnings before taxes, just a gross profit minus depreciation. See, you're making a loss, and it's a much bigger loss and in the last year, and that's because of the very high depreciation. But that has a benefit because your tax is you're going to have a bigger tax rebate. So we do the tax, and it's 25%. So 25% of EBT. As you can see these figures here. And so net income. Net income is just the EBT minus the tax. Now, if you look at the first year's net income, you'll actually see that it's the same, and that's because the depreciation is the same. But then afterwards, it changes quite dramatically. Okay, so now we can do some calculations. What's the average net income? Well, we do that over 5 years. We can say average net income. So the average net income is 50,000. Okay, and why is that? Well, I'll talk about that in a minute. What is the average book value or the average investment? Well, the average investment is this, the average of this, and we've actually, because the spreadsheet dynamically updates the figures, because these are the new figures, our average, as you can see here, of the book values is 280,183, and I'm just going to use a formula to make everything dynamic. We've got the average investment there. So what's the average accounting return? 17.85%. So if you use reducing balance, your average accounting return will be less than if you use straight line depreciation. If I was just to make it percentages and increase the size here, just so put it to 2 decimal places. 17.85 compared to 20%. So your depreciation method will impact upon the return that you're getting. And that is because the depreciation method affects the tax that you're paying. The method itself stays the same. It's 3 steps: calculate the average net income, calculate the average investment, and divide the average net income by the average investment. And that gives you the average accounting return. This method is really quite popular in the UK. I would say about 40% of British companies use average accounting return. If you look elsewhere in the world, it's much lower. Maybe between 1 in 4 and 1 in 5 companies use that. And I discuss that in my textbook. So, what are the strengths? What are the weaknesses? The strength of this method is that accountants find, they're comfortable with using these values. It's directly tied into the income statement. They can see the direct link between your financial, predictions through the accounting statements and decision making. So accountants are comfortable with that. The weaknesses, well, the weaknesses are that the values that you use are dependent upon the accounting adjustments you make. So how your depreciation clearly has an impact on net income. There's no account for time value of money, the risk of the cash flows, or the timing of the cash flows, and the target rate or the benchmark rate is set irrespective of the project or the risk of the project. It's usually a company benchmark rate. So strengths and weaknesses, as I said, a lot of companies use this method, so there is definite value in this method. And I hope this video has been of some use to you. And I'll be covering other videos in the future from my textbook. Thank you very much.